What if I told you that you are spending hundreds of dollars more than you have to for your mortgage payment every single month? What if I showed you ways to make your mortgage payments on time, save hundreds of dollars a month, and pay down debt all at the same time? By now, I am sure you have seen this discussed on Instagram and on TikTok by all the realtors and loan officers. What I'm talking about today is an adjustable rate mortgage, known as an ARM, and a 2-1 buy down. I have helped hundreds of families get into home loans in the last 8 years when it comes to purchasing a home. These products are only a couple of the different options that may be available to you when the time comes for you to get ready to buy. While these two loan products do help borrowers save hundreds of dollars a month, there are some people that would consider these loan products to be scams or even predatory. By the end of this video, you will know exactly everything that you need to know about these two loan products, whether or not it's considered a scam, and whether or not you should stay away from it. So what is a buy down? A buy down is an option for a borrower to be able to save hundreds of dollars a month for the next 2 to 3 years, depending upon which loan product they go with, whether it is a 2-1 buy down or a 3-2-1 buy down. A 2-1 buy down is where you will take today's rate, reduce it by 2 points for 2 years, and it gradually increases each year until you get back to the point where today's market rate is. So for example, if today's interest rate is 7%, you will be able to pay 5% in the first year, 6% in the second year. In the beginning of the third year, you would be back to the market rate of 7%. The same thing is true for a 3-2-1 buy down. It works exactly the same way. It just extends that period of time a little bit longer for a little bit more savings. So today's market rate, again, for an example, is a 7%. In year 1, you would have a 4%, year 2, a 5%, year 3, a 6%, and at the beginning of the 4th year, you would be back to the market rate of a 7%, and you would be expected to make that payment for the remainder of the term of the loan. An ARM, an adjustable rate loan, is something that is kind of the same, except it's not necessarily temporary. So you have different options in terms of the years with that loan option as well. An ARM is an adjustable rate mortgage. So for the first 3 years, 5 years, 7 years, or 10 years, depending upon which option you choose to go with, you will have an interest rate that will be below today's market rate. The cut is not as deep as the buy down that I mentioned previously, but it does save you some money off of today's current rate. So for the first 3 years, the first 5 years, the first 7 years, or the first 10 years, your rate would be locked. It would be fixed for those first few years. So again, using my example, if today's 30-year fixed rate was, say, 7%, your first 3 years, 5 years, 7 years, or 10 years would be, let's just pretend, 6.5%. Once that time has expired and it's time for the rate to adjust, your rate could go up or it could go down at a predetermined amount, which you would be aware of at the time that you get the loan. So it would not be a surprise when it's time for your interest rate to go up, or in some cases to go down, depending upon what the market is doing at that time. Well, Joy, why is everybody talking about this all of a sudden? I mean, isn't this supposed to get people's homes taken? Oh my gosh. Well, yeah, some people feel like that. So as you know, interest rates have been skyrocketing in a relatively short period of time, as have home prices. And these are loan products that are designed for a very specific group of people to be able to get into the home, save a little bit of money, with the promise that maybe they should be able to maybe refinance into something that's more permanent, depending upon what it is that they have planned for their lives after that initial period of time is over. Every single loan product has a particular audience in mind when it's been created. So what you need to know is if you're being scammed or if this is something for you. What I want you to do now is just drop down in the comments and tell me, how do you all feel about ARMs or a 2-1 buy down? Now that you have a little bit more information about it, I love to hear what it is that you all have to say. So, give me something to talk to you about and kind of clear up any misconceptions that you all might have. All right, so let's start with the good part. Who is this product for? Who is this 3-2-1 buy down or the 2-1 buy down or the adjustable rate loan meant for? They are meant for people that are responsible with their money. It's meant for people that have low debt. And it's meant for people that do not use and abuse credit. And finally, it's going to be for someone that is highly strategic about the way that they spend their money in investments. These loan products generally come with the promise that you're going to be able to refinance at any time if you decide this is something that you are no longer comfortable with, or if you see that the interest rates may be going in a direction that you're not comfortable with. In order to do that, you need to be somebody that fits that description that I just talked about. Is your debt to income ratio still in line to be able to do a refinance? Is your credit score still high enough to be able to do a refinance? Have you abused or missed payments on your loan amount? These are all factors that go into being able to determine whether or not somebody can or cannot refinance when the time does come. One question that I get a whole lot, and I really want to get this cleared up: how long do I have to wait to refinance? The answer to that question is you're going to be able to refinance at any time that you feel or that we're able to show that it's going to be financially advantageous for you. So going from an adjustable rate loan into a fixed is a great reason to refinance. Also, let's say you get into the loan today, and then 7 to 8 months down the line, interest rates start to plummet and you want to lock in that lower rate. It's a great reason to go ahead, lock in that lower rate by doing a refinance into a 30-year fixed loan. So, well, Joy, this sounds like it's a good opportunity. I mean, I can save hundreds of dollars a month, right? Yes. So, for example, on a 2-1 buy down, okay, for the first year, let's just say the difference between your 7% rate and your 5% rate, you say $300 a month. That's $3,600 in that first year that you're able to take that money and potentially reinvest it somewhere else or consider like paying that debt down. Whenever you're qualified for that home loan, we're not qualifying you at that lower rate. We're qualifying you at whatever the market rate is for today. So it shouldn't be unduly burdensome to you when you are signing on the dotted line at closing for that home loan. That second year, you're going to go up in rate. And let's just say that now, instead of $300 a month you're saving $100 a month. Well, that's great. That second year, you're saving another $1,200. That is awesome. You have now been able to save about $4,800 over the course of the first 2 years that you have been into your home. So, who is this loan not for? This loan is considered predatory under these circumstances. Getting into a home loan like an ARM or a home loan like a 2-1 buy down or a 3-2-1 buy down is going to be harmful to somebody that barely qualifies. I would not suggest getting into a loan like this if your debt ratio is over 40%. That means that you are already in a precarious enough situation where if you go out and you run up some credit cards or you purchase a car over the next 2 years, 3 years, you may find that you are in a situation where when that payment does go up or it does adjust, it may be uncomfortable for you to make those payments each and every month on time the way that you promised. Because what I will tell you is a lot of times when borrowers walk away from the closing table, they forget everything. The only thing that you know is that you got keys in your hands and that you have bought a house. You forgot all of the circumstances and documentation and paperwork that you had to submit to get that loan. So it is extremely important to understand when we start talking about predatory lending or scam, loan products are designed for specific people under specific circumstances. If you change your circumstances, you may find that you are in a situation where you will no longer be able to maintain your home. I would never recommend this loan to someone that has low wages. Well, Joy, like, what does that mean? Does that mean somebody that makes less than six figures? Maybe. It depends. If you have enough money in your budget and you have lots of money left over, then a little adjustment of $200-300 a month, it shouldn't take you under. If you're in a situation where you are a single person going into this loan and you know there isn't anyone else in the background that's going to be able to help you each and every month, this may not be the loan for you. You want to make sure that regardless of if the payment increases $200 or $300, you will still be able to maintain it. So when I say low wages, I don't necessarily mean a dollar amount. What I mean is sometimes people have to qualify for a home by themselves, even though they may have additional income coming into the household. If you know that you have additional income coming into the household that as a lender we've not considered, this may not be a big deal or a deal breaker for you in your home. Lastly, this is not for you if you have bad credit. Bad spending habits, bad credit, this is going to end up in a financial disaster. I think that this product is going to be considered predatory if you're someone that already has proven that you struggle with paying debts on time, because you will most likely find yourself in a scenario where you have misappropriated funds and you've gone out and you've purchased things and potentially overextended yourself in your finances in other areas. So when those rates do start to change, you may find that you have some challenges with meeting that monthly mortgage payment every single month. All right, you guys, you made it this far. I just have two more things that I want to tell you. I'm on a journey tracking towards 1,000 subscribers, and I really, really need your help. So if you found this information to be helpful, please go ahead and hit the subscribe button for more information like this, as well as the like so that they can push this content out to people that are in your same shoes that would like to get this information to determine whether or not the ARM loan or the buy down is a scam or if it's something that's going to benefit them and their family. But right now, I'm headed towards 500, and I really want to start to go live once I hit that 500. So those subscribes are really going to be helpful to get me there a little bit faster. So while I'm building this community of bosses, do me a favor. Drop down in the comments and give me two questions. What two questions do you have about purchasing a home and home loans? If you see that there's somebody that may have taken your question, just go ahead and give them a thumbs up and a heart. So I'll know that this is some content that you all want to hear more about, and I may need to make a separate video about. But I will be in the comments to answer your questions. So please, please, please drop down, give me two questions, maybe just from this video, something that I did not answer for you, or just a general question that you have about home loans. Lastly, if you enjoyed this information and you enjoyed this video and you learned a lot, check out this playlist that I have about credit. It gives you tips and tricks and things that's really not shared to the public about minimum credit scores that you need and how to get there fast. Y'all, thank you so much for tuning in and have a great day.